Today we are going to look at a very common question. Should I put my extra saving into my mortgage offset account or should I invest that money in the stock market? Let's explore both options and see which one would work better over time. For example, imagine you have an extra $1,000 every month. Should you park it safely in your home loan offset account or should you let it work harder in the stock market? Today we will compare both paths, safety versus growth, and see how they play out. Our aim is simple. We want to compare what happens if you put spare money into one and an offset account which reduce your home loan interest versus investing in shares like the S&P 500 index. At the end, we will understand the trade-off between playing it safe and aiming for growth. Let's understand this with a simple example. Think of this as choosing between two jars. Jar 1, the offset account, safe, steady, no surprises. Jar 2, investing in shares, less predictable in the short term, but with the chance to grow much bigger. By the end, you will see which jar might suit you better. To make this comparison realistic, we use some basic assumption. Imagine you say $100 each month. We looked at this over 50 months. That means you have put aside $50,000 in total. We assumed average home loan rate in Australia of around 4.67%, which is 200 basis point above cash rate when the interest rate was too low and 150 basis point above cash rate at current state. And for shares, we used S&P 500 index monthly absolute return for over 50 months, which returns about 15% on average in this time period. These are average, not guaranteed. Here what we found, if you use the offset account, you would have saved about $6,000 in interest on your loan. If you invested in S&P 500, your money would have grown by nearly $18,000. That's the difference of about $12,000 more with investing. Of course, the share market can go up and down, but in simple example, it clearly outperformed the offset account. Now let's look at offset account. The big advantage here is certainty. You know exactly what you will save because it reduces your loan interest. It also risk free. You won't lose money and your money is always available if you need it. That might that makes it great for people who prefer safety or who are closer to paying off their loans. Think of an offset account as safety net. It always saves you money on your loan. No ups and downs. What you see is what you get. And if you need money tomorrow, it is right there. It's like keeping your cash in a piggy bank that allow also reduce your mortgage bill every month. This account is useful for saving emergency fund. On the other hand, investing in shares has the potential to give you much higher returns, especially over longer time frame. History shows that if you stay invested for at least 3 years or more, shares tend to outperform loan saving. The catch is share price moves up and down. You need to be comfortable with some short-term ups and downs to enjoy the long-term growth. Now think of investing like a planting a tree. In the short term, storm might shake it, shares can go up and down. But if you give it time to grow, the trees get bigger and stronger and the returns compound. History shows that if you hold your investment for at least 3 years or more, chances are you will do much bigger, better than just saving an interest. So, what's the smarter move? It depends on your situation. If you want certainty and reducing the debt is your top priority, the offset account is a great choice, especially for saving for emergency fund. It's a great investment option or saving option. If you are looking for growth and can handle a bit of market movement, investing might give you a better result over time. In reality, many people find a balance, splitting extra saving between the offset and investment to get both security and growth. To wrap up, the offset accounts gives you guaranteed saving. Investing has higher growth potential, but it comes with ups and downs. The best choice really depend on your risk appetite, your financial goal, and how long you plan to keep your money invested. There is no one size fits all answers, but understanding the trade off help you to make a smarter decision. To put it simply, the offset is like driving on a cruise control, steady and safe. Investing is like taking the fast lane, more exciting, but you need to hold the wheel steady through bumps. The right choice depends on you, your comforts with risk, your long term goals, and how long you can let your money grow. Finally, an important note, this information is general only. It doesn't take into account your personal circumstances. Past share market returns don't guarantee future returns results, and loan rates can change. So, before making a decision, it's always better to speak to a licensed financial advisor.